In an industry where a company that's a long-term investment is hard to find, there is one gold company that may pique your interest for gold investing, and that is Sandstorm Gold. Sandstorm Gold is a royalty and streaming company that provides capital to gold mining companies in exchange for a cut of the gold that they dig out of the mine. And Sandstorm buys that gold at a low fixed price, typically around $400 per ounce on average. There are a few gold royalty companies out there, but we think Sandstorm is worthy of your own due diligence. As a disclosure, we are proud shareholders of the company, and although we hardly advertise gold stocks, we believe in the Sandstorm management, led by former executive of Silver Wheaton, Nolan Watson. Sandstorm is geographically diversified with exposure in North and South America, Africa, and Asia, and has 21 producing assets that have netted them an increasing amount of positive operating cash flow and revenue in the past 4 quarters. They also have 22 mines in the development stage that will increase their cash flow substantially in the next few years. Be sure to check out Sandstorm Gold at sandstormgold.com/invest. Hi everyone, this is Jason Bierach of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has over 20 years experience analyzing stocks. He was a former editor of Stansberry Research's Small Cap Specialist based on the biggest trends in the world. He's the host of the popular Wall Street Unplugged podcast, one of the top business and investing podcasts. And his late dad, Frank Curzio Sr., was a portfolio manager and wrote a financial newsletter for over 30 years, including having written correspondence with Warren Buffett. Frank Curzio, thank you for joining me again.
Thanks so much for inviting me back, man.
Now, Frank, I've been listening to your podcast for years. You go all over the place. You're very knowledgeable about stocks in many different industries. What's your opinion on the valuations of large cap stocks? You know, I have a lot of my listeners who are looking for income in stocks, but when I look at the large caps right now, I see a lot of different valuation metrics, and I see a lot of overvaluation in the large caps, whether it's a 28 PE on the CAPE ratio, which is Robert Shiller's, or other valuation metrics.
They're expensive right now. If you're looking at CAPE and those type of ratios, I could tell you it's good to use those when you're doing comparative analysis, where you're looking at other companies and CAPE ratios. But I could tell you if you're looking at Shiller's, I mean, I know his methodology, but really if you look at the way that methodology is formed, which I have done, it's kind of useless to investors because based on his methodology, stocks have been expensive for the last 7 years, probably since 2010, and you might have not have been in stocks. For me, what you want to look at is growth. Okay, that's a big component that you need to look at. And when you see this growth and you're seeing it kind of slow down over the past few years and these valuations are getting higher and higher, it gets a little dangerous. Now, why are we still going higher? Well, all of a sudden, Trump got elected, and he has a lot of pro-growth policies in the U.S., and that's pushed financials through the roof. That's pushed infrastructure stocks through the roof. Even some healthcare within different segments of healthcare have done very well. Now, you know, and then he's got tax reforms to repeal Obamacare. So a lot of this stuff is being priced in like it's going to happen already. And you're looking at the healthcare plans where Obamacare, for me, Obamacare, I think, is not a complete joke. I think there's some parts that make sense, but for me, when it comes to Obamacare, running my own business, Curzio Research, my healthcare costs are more than my mortgage. So just to put that in perspective, and they're going to go up on average probably 15 to 20% annually if the plan stays the same. So a lot of these things that are going to change, they take a long time to do. And the fact that we're pricing in all of this like it happened already, and these tax reforms, even if we go back to the Reagan administration, his tax reforms, those policies did not take place and get passed to the 5th year, his second term. If you look at infrastructure, the biggest infrastructure plans that we've ever had was back in the 50s in the Eisenhower administration with the highway bill, building these massive highways across the country. We still had two to three recessions, actually 3 if you count the 4 or 5 years after he made that announcement. So the fact that we're this whole Trump rally, like everything's going to, it's acting, especially a lot of these stocks, that all this is in place already. This could take years, 3, 5, 7 years. Who knows if he gets a second term? The fact that the valuations are moving higher, that this already happened, that's really scary. So you're right when it comes to valuations. It's very expensive, almost like a minefield. You got to be very, very careful because we may not see the growth that's expected or most people expect after Trump got elected.
Yeah, I agree with that. I don't think there's really been any fundamental reason for the growth in stocks really during the Obama. I think, so many global central banks have pumped so much liquidity into the system, and it's propped up real estate prices, bond prices, stock prices. When I look at share buybacks, when I look at investing from the large cap companies, they haven't put nearly as much money into capex as they have. The oil industry has cut back massively on capex, so eventually that's going to be a problem probably at some point. So I think, the large caps are not, there's some value there if some of the companies bomb earnings for a while, like maybe Chipotle. Eventually, if you're patient, they could turn things around, because I do notice that there's long lines at certain Chipotles locally that they could eventually turn their business around. But in general, I don't think there's a lot of value right now in the large caps, because I think that's where a lot of capital in other countries are going to park their money. They're coming into the United States. And I think, the rally for the Trump has been hopium. A lot of the financial rally and the Dow rally, Frank, it was almost 30% was all Goldman Sachs. We had a 30% rally in Goldman Sachs shares, and that made up the majority of the rally in the Dow to get it over 20K since Trump won.
Yeah, no, it's amazing how when you look at the Dow too, it's a price weighted index. So you're looking at different companies within there. The higher the price, the more weight they have. It's not even based on market cap. But you brought up something interesting what you said there, Jason, because you're looking at capex. I mean, you know as well as I do in the mining industry with all the people you interview and know. Capex, they cut significantly, the majors especially. Why? Because they were so leveraged, they had to deleverage, especially with gold prices falling. So we had all commodity prices falling. You also mentioned that in the oil industry. But when you have that underinvestment, what does that mean? Now you look at the gold industry, name the last major discovery that we found, or, over the past 5 years, there's been very low because there's been very little investment. And now what happens? Now, because that underinvestment, you see prices go up. We've seen it in uranium, right? I mean, now we're finally seeing it where there's fundamental changes. We're seeing cuts out of, the biggest producers in the world. And we're seeing a lot of supply that's going to come online over the next few years. Fundamental changes. We saw it with oil. So what does that mean? I mean, prices are going to go higher, and that's going to be good eventually for oil companies. We've seen it go pretty good right now, right? We've seen oil go from below 30 to over 50. Remember, guys, it was over 100 not too many years ago, 3-4 years ago. So when you see these fundamental changes, that creates opportunity in a lot of these, sectors like uranium. We've seen oil, and now we're seeing gold, where the majors have their balance sheets are much, much stronger, and they're on a hunt for assets, for high-grade gold assets. They need that. These are producers. They need, the junior miners are a great place to be if you could find ones that are focused on high-grade areas, good infrastructure. These are what the majors are looking at. Same with oil. Where are they invested? Not everyone in the Eagle Ford, not everyone in the Montney, not everyone in these areas have prime real estate. These are big areas, but they're going to focus on the ones and maybe take over the ones that have the best real estate. So when you see the fundamentals change, it could provide good opportunity in some of these sectors.
I was listening to your interview with Marin Katusa on your podcast recently, and he said that the amount of uranium juniors, it was around 500, now it's down to 5. So
amazing, right? It's amazing.
Well, if I don't know that's an example of a bear market, I don't know what is. So if that's not an example of what a bear market is, that's a classic case of a bear market then. The sentiment has just... Mm-hmm. Yeah, the sentiment is just totally, purely bearish. Now, obviously, there's been a supply glut because Japan hasn't restarted their uranium reactor, so they sold a lot of their supply onto the market post-Fukushima, and then Europe has been shutting down some of their nuclear power reactors, nuclear power plants, and China hasn't brought as many online as quickly as people thought. But eventually, though, I think, uranium markets are going to have to, they cannot run at a negative loss for forever. So this supply-demand imbalance is going to have to work itself out.
Absolutely.
I just wouldn't, what I learned, see, I had a fourfold gain. I bought Denison, for a story for our listeners. I talk about my investing losses on here. I bought Denison right after the 2008 crash. I bought it at $1 a share, it went up to $4, and I thought I was a genius. And then Fukushima happened, and within a week I lost all my gains. So I wouldn't put too much of my money into uranium because there's always a potential for, a nuclear power plant disaster around the corner. But I think if you're going to put a small chunk into their uranium exposure, I think it's probably a good idea for risk reward, how undervalued it is.
And you bring up a good point, because even when you're investing in juniors, guys, remember, they don't generate revenue, they don't generate earnings. So that means they're going to have to raise money constantly, right? Which is a normal procedure in that market. It's a normal procedure in biotechs as well, right? Early stage. And, as your funds, it's almost the same. It's very similar industries, right? I mean, if the FDA approves, phase one, obviously that's good news. Stock's going to go higher. They'll use that to raise money. And just like if you have good drilling results, the same thing. And a high grade, you're able to raise money. But if the market's not good in these areas and for a long period of time, I mean, you're not looking at IBM, you're not looking at these major companies like a Nike that will cut costs, shut down plants, and be okay, and they've been through this for decades, 30, 50, 100 years. You have companies that are relying on that price to go higher, and the longer it doesn't go higher, there's costs to continue to operate, to continue to drill, to continue to pay employees that they don't have, and their stock goes low, they have trouble raising money. So just understand that these are extremely risky stocks, and one of the things that I saw, Jason, I don't know if you saw at Vancouver Investment Conference, what a difference a year makes, right? I mean, last year, nobody wanted to do anything. No deals. Everyone's scared of the market. This year, I mean, I could have created a fake company and raised $5 million for it. I would, obviously, I'm kidding here. But, I mean, everybody just wanted to invest and do private placements. People who are raising $5 million were raising $15 million. It was just everything was overfunded. Just be very careful here. I mean, these are risky stocks, and I'm with you. I think gold's going higher. But you have to be careful, especially when you have these great gains. Take a little bit off the table, maybe. But right now, it's just the optimism. It's just amazing how quick it shifted within 12 months.
Yeah, I know you like Sandstorm Gold, Nolan Watson. You've interviewed him. They're a sponsor of our show. I've interviewed him for many years. I have it's one of my largest holdings. It actually is my largest investing holding because I know his track record and how hard he works to grow the company. But they didn't really get any deals done in 2016, and that was because a lot of the juniors and regular miners were able to raise capital on their own. So I think that shows, how people were willing to lend. I've also heard some of those stories of juniors, like you said, being able to raise money. I've heard people got to be really careful. There's starting to be some really bad juniors coming online again, where there's people raising $5 million, like you said, who have they don't have any geologists on staff. They have no background working on Wall Street or in Vancouver, any financial background. But, they know like 20 guys who each wrote them a big check. So you got to be careful about that. Just because they're telling you a nice story, there's that. Did you see that Matthew McConaughey movie that just came out about gold?
I haven't seen it yet. No, I'm looking forward to seeing it. I'm probably going to see it in about 2 days.
Okay, I saw it this past weekend because I don't have much of a social life anymore. So I saw it over the weekend, and it was a great. It's based on a true story with the Briec scandal. But for those of you who have so much exposure to junior miners, I mean, you need to be very, very careful how much exposure to have junior miners. I'd rather be buying, companies like Silver Wheaton or Sandstorm Gold right now because they have cash flow and they have the cash. Not only the cash flow, they have the capital to go do deals if they're available.
And my conversation, Jason, with Nolan was interesting because Nolan wants gold prices to come down. And that may sound funny at first, but if you look at 2013, 2014, 2015, that period, Nolan has signed over 100 royalty and streaming deals. Why? Because everybody was dying for cash. And these aren't streaming deals that you're talking about little miners. He did a lot with the majors because the majors needed cash. They were so leveraged, they had to bring in cash. And there he was signing these amazing deals. And like you said, now it's harder. And I was, joking around a little bit, right? We'd love to see gold go to $5,000 an ounce. Of course, it'd be, Nolan would be perfectly fine. That stock will go through the roof. However, the way Nolan thinks is, wow, I wish the market was bad for a couple more years because we could sign another 30, 40 deals. And when goes to 5,000, say it takes an extra 5 years, my company's going to be 4 times the size than it would if it happened right now. So his level of thinking is almost how investors should think. Who benefits when gold goes lower? Well, if you look what Amir Nani's done with Brazil Resources, which is now called Gold Mining, he's a guy that created a company while everybody else was selling and trying to raise money going crazy. Here's a guy that's buying assets at dirt cheap prices. I mean, some projects that was selling for, based on their market cap, over $100 million, he's buying for $4 or $5 million, and now he's sitting on 18 million ounces of gold in the ground with a very low valuation. So if you look at guys like that where who are the best people to benefit if gold prices do go down, and you have a long-term outlook on gold, say 5-10 years it's going to be higher, that's even a safe way to buy some of the greatest companies where that's not a great strategy if you bought the majors because as gold prices came down, they had to leverage, they weren't taking advantage of that market. when you have guys like Nolan and Amir Adnani who had taken advantage of one of the biggest bear markets that Jay, that the biggest guys in the industries have been around for 40 years. Rick Rule, Eric Sprott, those guys say it's the worst market they've ever seen in their career.
During the 2008 crisis, I saw the best deal in the resource industry I've ever seen anyone make. Franco-Nevada, which is the largest gold royalty company in the world, they don't have any debt on their balance sheet to grow. They have a small dividend, but it grows every year. And so one of the miners, Coeur d'Alene, was bringing online this massive gold and silver mine in Mexico called Palmarejo, and the markets were frozen. No one could get any credit then. So Franco-Nevada was able to buy over $1 billion of gold in the ground. They got 50% life of mine for Palmarejo, and that mine was up and running and ramping up to full operating cash flow, free cash flow, and they got full life of mine, which could run for decades, for over 30 years, for only $80 million. So they got over $1 billion worth of gold reserves in the ground for only $80 million, because they were the only ones who had cash, and Coeur d'Alene, the mining company, had to bring the mine online to get the cash flow because they had already sunk in too much money.
Yeah, and that's amazing. And you know as well as I do with Keith Neumeyer as well. I mean, he's got a knack for calling markets where, 2002, he's built how many billion-dollar companies? He did the same thing. First Mining Finance recently, First Majestic Silver. He's done it with First Quantum. In Africa, we want to first be able to invest in there, but just almost at the bottom of the markets. And here's a guy that created so much wealth for so many of his investors, including himself, by investing at the right time in the markets. And that's why when I see this huge bounce coming in with the gold, you have to be a little more selective when people are sitting on 200-300% gains in some of these stocks and they're adding to their positions here. Just be careful. I mean, you want to make sure you're doing, portfolio management is just as important, because when the market does fall, and if it falls, or if it's going to fall again, maybe gold goes to 5,000 straight from here. But when it does, the people who make the most money are the people who are prepared. And how do you be prepared? Well, maybe you have stop losses on some of your stocks. This way, you'll take a 25% loss, and that would have worked out great for the S&P 500 because, when you saw that massive decline to 666, imagine having millions of dollars to invest. You could have just closed your eyes, invest in anything, and you're up 200% on even the safest companies in the world. I think it was 20% of the S&P 500 traded under $10, 18% to be exact, at the bottom, which was March 2009. It's like 1.5–2% of those stocks trade under 10. So that's when you want to take advantage. Doesn't mean you can't buy great gold companies now. It's just not as easy as it was a year ago. And I feel like we're at that conference where I see 100% of the people I talk to were super bullish. It just made me a little bit bearish, saying, people should be taking a little bit of profits and, add to your positions if you do see a pullback, because it is a cyclical industry.
Exactly, and I don't think people should be buying all of their positions at once. That's a really common mistake I hear from a lot of people who are retail investors who listen to this program, is they hear about a stock, do some research, they maybe read your newsletter, Frank, and even if I worked in the newsletter industry as well, even if we recommend and we write in all caps, right, every single sentence underneath the stock, do not buy all of your position at once, buy in thirds or fourths, or wait for dips, people still do it.
It's true, but listen, there's an excitement there. It's almost like a gambling addiction, and people want to day trade, and they get really excited about situations. But you don't know what's going to happen next month. I don't know what's going to happen in a couple months. But for most of my picks that have a 12 to 18-month outlook, for where I look for catalysts that I know will happen within those 12 to 18 months, I don't know. Like, for example, On Resources came down tremendously, and I think On Resources, run by Ivan Bibik, who's the next superstar in this industry. He already is a superstar. I saw that On Resources come down a ton. I'm like, wow, this stock should not even be close to trading here. They have high-grade assets. I'm like, the majors on a hunt. Sure enough, one of the majors signed a deal with them like a month and a half after I recommended it. I was lucky. I knew that catalyst was going to happen. At least I had a good feeling, but I said in the next 12 months, at this level, I can't picture a major looking at what they're doing and not investing in this with the possibility of helping them out, and these mines becoming, producing mines eventually, a high grade. It happened a month and a half later, and I got lucky, and we're up about 50–60% of the stock, very, very quickly. But that's the way I look at things. But I don't know if it could happen in a month. They may report bad drilling results, and the stock may fall 30–40%. Well, if I only took a quarter position, now I can go in and buy more and improve my cost basis. So you bring up a great point where you don't know what's going to happen. You don't even know what's going to happen with the markets, where a simple tweet could push the healthcare industry down 15% or a stock down 15%. You have to be careful.
Exactly, and that's proper risk management. So you should always at least have like maybe 10% cash out of your total portfolio holdings on the sideline for an opportunity that is unexpected. So if there's a market crash or a company bombs earnings unexpectedly, or, with the mining industry and resources, I did a short video a couple months ago and I listed, one of the problems with juniors, or even if you're a large mining company like Barrick Gold, there's dozens of things that can go wrong trying to bring a mine online. Look what happened with Pascua Lama. Barrick invested, it was supposed to only cost about 1.5 billion and the cost went to 6 billion. Now they're over 10 billion 4 or 5 years later. So there's just dozens of things that can go wrong bringing a mine online. The financial projections for I don't know if you saw this, the financial projections for New Gold, they're a solid mid-tier gold miner, at least they were. And so they were bringing online this new gold mine called Rainy River. It was supposed to be economic at $1,250 gold. The capex was, I think, 850 million, and the capex now is over 1.2 billion, and the mine's not running right, and so now they're in some financial trouble.
Yeah, and here's a quick thing for all your listeners out there. Whenever a company, any mining company in the world comes out with an estimate of how much it's going to cost, add 30% to it. It's at least 30%, and you'll be fine. Just don't even I don't care who it is. I don't care if it's the greatest executive in the world. Ross Beatty's amazing with it, and he'll probably tell you the same exact thing because Ross is such a great guy. Terra Power, and I'm sure a lot of your audience is familiar with him. But every time I talk to him, he always talks about the mistakes that he made, even though he's so successful. And it's just funny when anybody that comes out with the cost, it's just there's so many costs involved, and there's always going to be a problem. So just for a conservative investor, if you're really modeling or you're looking to, when they come out with that estimate, just add 30%, you'll be fine.
Yeah, and it might not even be the mining company's fault. It could just be the government in that country has not run their budget properly, and they're looking around for tax revenue, and they can't move the mines. So the mines are easy targets, and they go after the mining industry more. That could just be it. But speaking of Ross Beatty, have you taken a look at how Alterra Power has done? I remember that story. Marion Katusa and Rick Roll and others were talking about geothermal as a value investor. I wasn't really interested in it because of how hyped it was in 2008, 2009. So I was just watching the industry, but now like hardly anyone talks about it, and it's unloved. It's a contrarian thing, and yet 8-9 years later since it was hyped, now all that capital has been sunk in, and these Canadian geothermal and clean energy utilities like Ross Beatty's Alterra Power, these things are growing their revenue 15-20% per year, and they're starting to pay dividends now. So I've actually done well the last 3 years investing in Alterra Power. I think I bought it near the bottom in 2013. I'm up like around 78% in 3 years.
Yeah, and I did a site visit with Ross and Marin early on, so in Vancouver, and we saw, it was amazing going to Vancouver and seeing the sites and stuff. And the thing is with renewable energy, and I'm not investing in this company because I got my what handed to me every time I try to invest in alternative energy, but this one's a little different because when you're looking at, you're looking at wind, you're looking at sun, some power. It's, it's base load. You want to have something that's always providing energy, and the wind you need to blow, the sun you need, but where you look at some of these, his water projects, and that's one of the ones that we focused on, the biggest cost to renewable energy is, and a lot of these projects, is building them. It's billions and billions of dollars, right? And that's what kills these companies, and it just takes so much to invest in these projects. However, when they're built, it's a steady revenue stream, infinite, forever. The water's going to flow, the wind's going to blow, the sun's going to come out. So, but the problem is the cost. You're always going to see massive debt levels in so many of these companies, and you're going to see so many, the politics involved, depending on what administration. You're going to have huge ups and downs. And I think Ross has done a great job keeping his costs down, signing deals, even with Warren Buffett on the debt end, but on debt for this company. But the thing with renewable energy, and the reason why so many people invest in these companies now, because it will provide a steady revenue of income for the life of the company forever, because the war is going to continue to run. Again, you just have to worry about the costs, but a lot of this stuff is built already for Ross. It didn't even convince me enough to buy it, and when we looked at it, it was it's like $5.30 today or whatever. I think it was maybe like $4 and went down a little bit. Now it's ramping higher. But if anyone can make this work, it's Ross, and he's doing a great job with it. But it was fantastic on the site visit, and got to learn a lot about Ross in the process.
Yeah, General Electric, Frank, also gave vendor financing to, I think, the wind plant. So General Electric was actually putting up a lot of the capex because I think it was mostly PR because obviously it was a tiny project, so it's not going to move the needle for General Electric. But they were offering, low interest rate loans to build out the wind farm in exchange for building the wind turbines and getting the plant up and running. So a small little company, that's going to move the needle, but General Electric, it's not going to at all. So I think, in that situation where you can get discounted capital from a company like vendor financing, they could take advantage. I want to transition now, Frank, and ask you about Donald Trump. He's a New Yorker. I'm a New Yorker. Well, I was born in New York. I grew up in California. I know you've lived in New York a long time before you moved to Florida. What industries do you think will benefit from President Trump the most?
If you look at and we grew up in the same neighborhood, which is cool, which is Queens, New York, and I've lived there for over 35 years before moving to Florida. But the industries that are going to benefit the most, I think, are definitely financials. By far, financials. Financials, the regulation that's required for financials, and it's so tough to talk about this because there's so much. The media always has an agenda, and it's all politics. Put politics aside. The capital that these companies have to keep on their books is making them too big to fail. They're already way too big to fail, but they have so much capital that they're not allowed to spend. They have these stress tests. They have to keep a certain amount. Just to put in perspective, I mean, the stress tests require three things. What is it? So they have to have enough capital on their balance sheets, the biggest banks in the world, to withstand a 30% decline in the markets. It's a 25% decline in housing, and more than a 10% unemployment rate. That did not even happen during the credit crisis, right? We were down 10% unemployment rate, very like 1 or 2 months, and that was it. But they have to keep this amount of capital. Remember, that financial crisis was the worst that happened in 75 years, right? So now, what do? It's normal. I hate to bring up this event, but think September 11th when it first happened. I mean, if you saw a plane a week later, you were like ducking. You were scared. I mean, the emotions that take place immediately after something happens is usually a massive, massive overreaction. Everybody gets calm. It gets back to normal again. We need to get these regulations down, not to the point where we're going to see another financial crisis. There's a big difference between having no regulation and having full regulation. There's a huge middle between that. And what he's doing is allowing these banks to lend more to qualified borrowers. We're not going to see huge subprime garbage all the time. We're prepared for this a lot more. We're not going to see synthetics of synthetic loans in the market anymore. So financials are going to benefit huge from the deregulation. And you're seeing that. Is it priced in? It's priced in, but these companies will add billions to profits. Not only that, you have interest rates expected to go higher. It's just like a perfect environment for financials. Unfortunately, a lot of them will run up, so if you're not in them, wait for a little bit of a pullback. Maybe you see it, maybe you don't, but there's still some really good financials. Even, try to get exposure to JP Morgans, the ones that pay a dividend as well, for conservative investors, because they have that growth component now, which is very big. Infrastructure as well, I think, is going to be huge. We're going to be building a lot more. So you're looking at infrastructure companies running through the roof. Healthcare, it's kind of tricky because I don't think we're going to pass a bill in healthcare that relieves those 40 million people from getting healthcare for free, which is unfortunately, I think the way they're doing it, where they're charging people who actually work their butts off and they're charging them a fortune to pay for the people who don't work, is pretty crazy. I mean, that's not extreme example, but, I'm sure some people, can't work and whatever. However, I don't see them, all 40 million people, not getting insurance. There's got to be something in the middle that they could work with where we keep a little bit of Obamacare and then restructure it. So you're going to see different areas in healthcare benefit, whether it's medical devices or, we talked offline, like stem cell research and easy FDA approvals and things like that. However, with that said, you have to be very careful because there's lobbying going on. There's a guy, Kyle Bass, famous hedge fund manager, who's underperformed the market, I believe, for a while. So this is his new strategy, challenging patents on biotech companies where on their signature drugs that got FDA approval. So if you challenge that patent where they're generating, say, 80% of their revenue, and they're able to reverse that patent, that can crush the company. So you'll see these companies fall 10, 15, 20% just on them challenging, because in the U.S. you could sue anybody you want. And that's the way we have it here. I mean, you could win, you could lose, but you can literally sue anybody you want. And, outside of you paying fees, there's really no consequences. So where am I getting to with this? You're seeing a lot of lobbying out there where almost every healthcare company who has drugs on the market has raised their prices significantly. They all have done it, 5, 7, 800%. It's not just the ones that they're going after with Mylan and stuff like that. And you have these lobbying groups, creating these massive stories about how this company raised their drug prices 700%. And so you're going to always see that overhang with this regulation, which makes me a little nervous about healthcare, pharmaceuticals, biotech. And you're seeing that in the market right now. It's an industry I want to avoid because there's just so much headline risk. And it's so easy to attack those companies because they've all have raised their prices on drugs significantly, which we really haven't seen as much when you have insurance. But you could basically say that for any company you want. And if you are in one of those companies where they have a whole attack going and lobbying and stuff, and I've seen it, you can really get crushed in a lot of these names. So there's a lot of headwinds within the healthcare sector under the Trump administration right now.
If there was more free markets in biotechnology, say the FDA cut a lot of the red tape and a lot of the costs to bring a drug to market, which is what is being proposed because I think President Trump is listening to Peter Thiel and some of the other Silicon Valley venture capitalists that are more experts in biotechnology investing. So, I think with more competition, if there was less patents available and more competition and drugs were given less years on patents, I think that would potentially lower costs.
But you can't really do that, Jason. You know why? Because, and I've studied this, and it's not, and I agree with you, right? It seems like a long time. It's 20 years or whatever. But it takes, an average, I believe it's like 12 years for a drug to actually go to market, and it costs over $1 billion to get that drug to market. So you have 12 years you lose. You have the patent, but 12 years that you lose before you could actually sell the drug. So it's really 8. So maybe if you could change it to, 5 years exclusivity once the drug's approved. I like that. Maybe that make for even better competition during the whole review process and during the early stages. But some of these companies take so long, and you got to go to phase 1, phase 2, phase 3, and even before that, the preclinical trials and safety issues. And in safety issues, it never goes smooth, and you have to resubmit data. It just takes such a long time in biotech. But I agree with you. I think they should do something after it's approved where, hey, okay, they approved this drug. They got 5 years for it by themselves. Whatever. Maybe that's a bit. I'm just saying the example is, once these things come off patent, think about it as your business. You created, how much money did you put into getting this drug, right? You put all your billions of dollars into it to get it to the market. You're making billions, and then some guy just comes over and says, okay, I'm going to make the copycat drug and cut prices by 80%. You're done. Is that free markets?
Well,
I don't know.
Also what we've had, though, because the rules and regulations and costs of bringing a drug through the U.S. regulation process and the FDA are so expensive and time-consuming, you have a lot of these biotechnology companies doing it in other countries like Australia and Canada and India and Europe instead because it's cheaper. So they'll take it through the regulatory process in those other countries. That makes money. They do the processing facilities there. And yes, the drug eventually comes over here. But then, if you're a cancer patient and the drug is over in another country, it's an inconvenient for you to go over there and get it. Or maybe it's not even allowed in the U.S. then because it hasn't gone through the approval process. So I think, I really don't I'm not in favor of, I live right outside of Washington, D.C., and there's a lot of people involved in the FDA who actually have no expertise in science whatsoever. And then you have a lot of the large people at the large I've actually seen this because I've speculated in biotech stocks too. You have a lot of the big pharmaceutical companies, Frank, who know that they can just block a drug with a tiny little company that has good patent portfolio, and they just kill the drug. They say, oh, you need to do more safety trials intentionally, even though they don't really need it. And it just delays it. The company can't raise more money. And then the big pharmaceutical company comes in and buys the patents for pennies on the dollar because they know the little guy can't raise any capital. So I've seen them use, the FDA as a weapon against competition and the little guys.
Yeah, absolutely. And with the FDA, too, the approval process, I don't know if you remember, even as much as 5 years ago, 10 years, 15 years ago, it's 10 times better today, even though it needs to be much better. But they approve them much faster today than they ever have. But it's still, I agree with you. That process could be a little more smooth. And it's going to be interesting to see the regulation coming out because that's going to be a boom to that small microcap biotech market.
Yeah, and there's been studies, too, recently saying that the U.S. had a lead in biotechnology up until about 5 or 10 years ago, and then other countries started to catch up because of the costs of bringing the drugs here through the regulatory process of approval here in the U.S. So they've been going to other countries first. So if the U.S. wants to maintain its edge in whether it's medical devices or stem cell research or so many of the other drug technologies that are coming online, they're going to need to get things more streamlined. I want to transition now and ask you about long-term trends. I know you go to the Consumer Electronics Show every year. What were some of the amazing technologies you saw? Virtual reality or robotics or 3D printing this year?
I would say I could talk about two trends that I would definitely not invest in. That's 3D printing and wearables. Wearables, the market is actually close to declining. We've seen Apple dominate this market, but you're looking at companies like Fitbit. I mean, there's so many companies. There's probably hundreds of them that I've seen. I attend this show every year for the past 5 years. There's so many wearable companies right now, and it's hard to tell the difference. Even it's Garmin, they all kind of do the same thing. There's not too much of a difference. Some of them do, of course, but the fact that if you go back and look at the numbers, 2 years ago, even Apple, the number that they put out there, the market's bad and worse than Apple believed. Even though it's probably a $3 billion business, which is an amazing business for anyone in the world except for Apple, since they generate $250 million in revenue. But the numbers that they were putting on this and thought how big it was, it's amazing to see these numbers come down right now. And even Apple, you could tell that they're not satisfied. Otherwise, they'd break out the vision and tell you how many they sell. You could backdoor it. But any company that doesn't tell you how many gadgets or things that they're selling within a particular division, it means it's not that good, right? Otherwise, every company wants to promote themselves. You look at 3D printing, still there's companies, MarketBot was a big company that wasn't there this year. They're still cutting staff tremendously. For me, the growth market is the consumer, right? If you go from enterprise to consumer, where you go from 10,000, 20,000 customers to billions, right? Like Facebook and how many billions of 2 billion users they have. That's where it comes down to. But the days of you having a 3D printer on your desk are still very, very far away. The technology is very difficult to figure out. Very difficult. I mean, it would take weeks of training just to learn how to use these things, the materials. And you're seeing a huge decline in the market. It's a fantastic technology, though. We've seen it in healthcare, 3D printing of organs. I mean, and just even in manufacturing, it's amazing. But as investors, it's hard to invest in that market. These guys are still cutting everything, cutting their salaries, cutting employees, and those are two trouble markets. But the big market is the Internet of Things. This is something I was talking about in 2011. But it's everything that could be connected will be connected. We're not just talking about computers. We're not just talking about phones. And there was toothbrushes, regular brushes. There was chairs, desks. Everything is connected to the Internet, which brings in what other trend is big data. So big data is just the analyzing of all this data that comes in. When you're on Facebook, you're analyzing everything to the point where, and you probably see it yourself, Jason, I'm sure a lot of listeners do, where you're searching for something online and then you'll go to another website and you're going to see an ad for what you just searched for. That's how quick the algorithms work. And you're looking at the biggest thing by far, I think, it was Internet of Things, but this is part of that trend, is Alexa. Alexa finally found a way to make the connected home a reality. There's a trend I was talked about for the last 3 years. I'm like, no one's really going to connect their home. Alexa is the most amazing thing, where you don't have to go to an app, press this, press that, and turn your lights on. You could just walk in your house, Alexa, turn on your lights. Alexa, start my car. There's so many different car companies and manufacturers that are using this technology. And not only that, it's AI-based. Now, what does that mean? It means everything that you say to Alexa is going to the cloud, and it's saving everything that you say, and it's learning from you. And not only is it connected to Amazon, where, say if I run out of paper towels and we're cleaning something, I can say, Alexa, order me paper towels. Okay, thank you. Through Prime, be there in 2 days. And it's there. And then 2 months later, Alexa will probably know that to send you those paper towels after you do this after you have a year. But it's learning from you constantly, which is different from Siri on your phone. It's always learning, which is kind of a scary trend if you think about it. But just like the smartphones, real quick here, Jason, not to get too long on this. You had to buy a smartphone whether you wanted it or not. Now every light bulb, every washer and dryer, every coffee maker, every TV, everything you see is going to be connected to the Internet. And you're going to have an Alexa in your house or a Google Home, and you could use it through that Alexa. So now Alexa, you're going to see the connected home really take off now. Now they found a way to make it simplified. And you're seeing that right now where sales are through the roof. They're actually raising prices, and they're out of that supply on Amazon. Best Buy is discounting them. Trying to discount them, they even can. I mean, the demand is off the charts for Alexas right now, which is the Echoes.
I see some of the benefits that you mentioned, but as a libertarian, the privacy rights, how even when I don't want it to listen to me or to record, it still is. So, it's gathering data on me. It's very creepy, it's the stuff that it can compile on me.
It's a great point. Listen, it's extremely creepy. The privacy scares the hell out of me too. We're talking about investments, though, right? And that's where sometimes we have to put politics aside. Sometimes we have to put things aside. And I learned that even from David Tepper Appaloosa, when he came out in 2011, when Obama was just spending money like crazy, going nuts. And he goes, in 2000, I'll never forget it, because it changed my mind. I was bearish on the markets. He goes, you know what's going to go higher? Everything. He's spending money on everything. It's going to filter into the system. It's going to build the economy. There's trillions going in. He goes, this is going to kill us later on. We all know that. But right now, everything is going higher. And I'm like, wow. So when you put the politics aside and everything aside, I agree with you. It scares the hell out of me, especially AI. But Amazon's probably going to go a lot higher with that and the cloud. I mean, if you're looking from an investment purpose, you want to invest and make money in stocks. But again, I'm worried with you, and I hear you.
I want to ask you before I let you go about the oil and gas market, since you have a lot of experts on there. Now, I subscribe to another oil and gas newsletter from a guy who lives in the Houston area. He's worked in the oil and the gas industry for 20 or 30 years, too. And he thinks that Donald Trump's tax policies are really going to benefit the oil and gas industry. Also, because he's put out the executive order on Obamacare where they don't have to pay the tax. There's been a lot of rigs that have gotten back going again in the shale oil patches, all the different oil fields in Texas and Oklahoma. So what's your opinion of the oil and gas field? Are we going to have another bull market again based on the shale boom?
I do, but I think you have to be a little more selective here because it's all about technology. I wouldn't be buying oil companies because of what taxes are going to come down the line. It's going to impact every stock, right? I mean, you're going to see every stock with a high tax rate. If he gets his tax reforms passed, is going to benefit, not specifically oil, but oil will benefit. So I don't know if that's the catalyst I would use to buy oil stocks. I would focus on the nuts and bolts plays like the Schlumbergers, the Halliburtons, even Weatherford's a little cheap here, a little more aggressive stock. I know they have a lot of debt. But these are the companies that supply and have the best technology to lower your costs. And that's the great thing with the market. When you're seeing prices come down so much, and these companies were so leveraged, and when the hedges came off, that was it. I mean, I've visited every major shale area in the United States. I jumped on rigs. I was really into this trend and talked to the executives from so many different oil companies. I was very fortunate to know a lot of people in this industry. As prices come down, they're forced to improve their technology. And that's what's going on, where it costs $70 a drill, and it was $60. And now you're seeing Exxon come out. I couldn't believe Exxon came out and said, and this is about 4 months ago, and said right now returns are 10% with oil at $40. So they're drilling in shale areas at 40 and making money. Not every company is able to do that, but you want to buy the ones with the best technology because not only is it going to protect you on the downside. Right? If we see a bull market, buy the ugliest, riskiest stock, you probably get the most gains. We know that. But you want it from a risk-adjusted standpoint. You want to be able to buy the companies that are still going to be able to produce. I'm not saying to buy Exxon, but maybe Pioneer's taking off right now. EOG, these are the big players. Laredo Petroleum has LPI as a amazing technology. Also, they have great hedges in place for the next year, and they're right in the Permian, the Eagle Ford, in the prime areas. These companies are going to benefit the most, but it's not a bull market where you can just close your eyes and buy everything when stocks were at, when oil prices were below 30. You have to be more selective and focus on the companies that have the best technology where they could drill the cheapest. And you can go to the company, go on the website, check their presentation, and they'll talk about this a lot. This is a big theme. If you listen to conference calls, it's the technology. That's what you want to focus on. And trust me, you'll make a lot of money in the oil patch.
Yeah, to add to your points there, we're still in an oil. I think we're around $50 oil, give or take. I haven't checked the oil price today, but we're around an oil price where the deep water oil guys, it's not a high enough oil price for them to make any money. So I have to give credit where credit is due to the shale oil guys and the ones that are onshore here in the United States. I didn't expect them to be able to cut costs as fast as they have. I thought there was going to be a lot more bankruptcies the last few years because, initially when shale oil was getting going, I thought, once oil got below 65, a lot of them were toast. And they've just been able to survive for whatever reason. A lot of it has been cost cutting and being able to use technology better and become more efficient with their drilling.
And Jason, it was the hedges too. A lot of these companies had hedges in place, which were okay. And that's why when those hedges came off, I think oil prices were at $60 on the way down, $50. And I even said in one of I actually spoke at a big investment conference and said, how many of you all own one oil company, at least one oil company in your portfolio right now? And like 95% of the audience raised their hand. I said, you should sell every single oil company in your portfolio. Because the hedges came off, and then it's funny that you say bankruptcies real quick. There was about over 70 companies that went bankrupt in the oil industry. You don't really hear too much about them, but the other guys had hedges on a little bit longer and had so much assets they were able to sell and really cost cut and, like you said, and survive this. And you know as well as I do, if you survive it, just like in the gold industry, if you survive the worst markets and you get through that period, you're usually a superstar on the way up.
Yeah, and there'll be opportunities to buy assets for pennies on the dollar, but deep water, which has a much, there's obviously a lot larger fields available for deep water, but the capex for deep water is way higher than, say, for shale drilling. So deep water right now is, deep water oil drilling is not doing very well, but long term, to replace a lot of the oil production, that's going to be needed, but it's not economic at $50 a barrel oil or lower.
Yes, good point.
Well, Frank, your wealth of information. I really enjoy your podcast. Please tell our listeners more about your podcast and also about your newsletter.
Yes, you can find me on Wall Street Unplugged. That's the podcast, and we always help each other out with podcasts, right, Jason? I mean, it's a great market. We just like you. I interview guys for 30, 40 minutes. I also do another podcast called Frankly Speaking on Friday, where people send me in questions, and it's just a Q&A. And, we break down the markets and we tell you what's really moving the markets because there's so much noise out there, right, Jason? That's why people come to you. They come to people that they trust where, they filter out the noise. This is important. This is what you want to know about. And it's resulted in us, being number one, a few times and just a lot of success and a lot of, positive and, great word of mouth. So, and that filtered down to me starting my own business, which is, Curzio Research and Curzio Venture Opportunity Newsletter, which we've just sold, and it's been doing fantastic, which is, the reason why I travel the world, hop on rigs, and, cover all industries and try to find the best small caps and micro cap stocks for everybody out there. And we, the launch was a great success, and now we're starting to build a real business here, so it's a lot of fun.
Very cool. Did you actually get to stay in one of those man caves in the Bakken for a night, like one of those mining towns, the new boom towns?
No, I did go to North Dakota and the Williston Basin, which is amazing, and everything is just flat. I mean, it's just dirt roads everywhere, and I didn't go to the man camps, but it's amazing how it's just you go into an isolated area where nothing exists, and the people who work in Walmart are making $25 an hour. The people who clean the room are making $30 an hour because they can't get anyone to work there, so everyone's making a fortune there because you have guys coming in without education that can make $175,000 a year. Of course, that changed with oil prices coming down, but that was pretty. I didn't want to go in those man camps because I could tell you it probably wouldn't have been a pleasant experience since those guys stay there for a couple of months at a time drilling.
Yeah. Well, yeah, I wouldn't want to stay there for longer than a night or two, but yeah, just to stay there and say like I did it for a night or two would have been interesting. But yeah, staying there for months, it probably would have gotten pretty crazy.
Yeah.
I've read some of the articles about that and some of the stories how a lot of guys blow their salary like going out for drinks and on all the strip clubs and stuff. So
well, you know what? We did research on that. We had to do but it was funny, and I'm not even joking here, but. Because somebody told us about, and they had like two different strip bars, but they were telling us that the girls come in from Russia and they make $10,000 a week, which is more than what you would make in New York and all scores and everything. And I was like, you're crazy. And then when we went out and started drinking beers with all the guys and stuff, they're like, yeah, well, it's an unwritten law. Like when people first go there, they have to spend their entire check at these places, these young kids, and there's no dollar bills going around. It's 5s, 10s, 20s. I mean, it's pretty crazy there, but that's how much money these kids are making. In that oil industry. Of course, it corrected itself. It's a lot different now. But it's funny how, I don't know if that's an ultimate test of going to strip clubs to see if a business or a sector is doing well or not, but apparently that's what we were told.
Well, when you have a lot of men and it's all men, it ends up turning into a fraternity house. So
basically, yeah, I hear you.
Well, I enjoy your podcast, Frank. Keep up the great work. There's not as many contrarians out there as they used to because, on the mainstream financial television, whatever's going up is like, oh, you have to get into it now. And I prefer to be contrarian and look around for something that hasn't gone up yet, or it may be bottoming and there's an opportunity there to be contrarian and find something with value and then also find growth.
Absolutely.
Okay, great. Well, let's do this again, and maybe I can come on your podcast and give some stock picks in the near future.
Absolutely. We're going to set that up right away, I promise.
Mo and I are trying to raise $1,000 per month for our Patreon account. We have over 2,600 viewers per YouTube video, so if we can get most of our loyal listeners or all of our loyal listeners to donate $1 per month or up to $5 per month, which would be amazing, that would cover most, if not all, of the money that we need. So we also accept one-time donations if you go to the Wall Street for mainstreet.com website. We accept donations in cash via PayPal. Fiat, you can donate there. You can donate Bitcoin, through our Bitcoin wallet there on the website, or you can donate gold and silver. We have a gold money account, and we also accept mailed donations of physical gold and silver. Thank you guys for listening, and we appreciate any and all help. Please forward it to friends. Okay, bye.